Every few weeks, one person's words move trillions of dollars, resets mortgage rates, and decides whether your credit card debt gets more expensive or less. That person is Jerome Powell, chair of the Federal Reserve, and what he just said at the latest press conference matters more than most people realize.
Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment.
Here's the situation. For the past few years, the Fed has been walking a tightrope. Keep rates high enough to fight inflation, but not so high that it breaks the economy. Every statement Powell makes is scanned word by traders, economists, and mortgage lenders within seconds of it leaving his mouth. That's not an exaggeration. Algorithmic trading systems are literally programmed to parse Fed language in real time.
I guess it's fair to say that the economy's been stronger than many expected, given what's been
Notice the specific language there. The Fed doesn't like to make hard promises. They use words like data-dependent, gradual, and as appropriate. That vagueness is intentional. It gives them room to move without spooking markets. But if you listen closely, you can usually tell whether they're leaning toward cutting, holding, or even raising again. So what does this actually mean for you? First, mortgages. Mortgage rates don't move in lockstep with the Fed's benchmark rate, but they're closely tied to expectations about where rates are headed. If the market believes cuts are coming soon, mortgage rates often start drifting down before the Fed even acts, because lenders are pricing in the future, not just the present. If Powell signals patience or delay, expect mortgage rates to stay elevated or even tick up. Second, savings and CDs. High-yield savings accounts and CDs have been paying some of the best returns in over a decade because rates are still elevated. If cuts come, those yields will start falling, which means locking in a CD now before a cut can lock in today's higher rate for months or years. Third, credit cards. Almost all credit card APRs are variable and tied directly to the prime rate, which moves with the Fed. A rate cut doesn't happen instantly on your statement, but over a few cycles, minimum payments and interest charges can meaningfully shift. Here's the mistake most people make. They wait for an official rate change to hit the news before doing anything. By then, the market has usually already priced it in. Mortgage lenders, banks, and even credit card companies often adjust ahead of the Fed's official announcement, based on the same expectations we just broke down. So what should you actually do with this information? If you're planning to refinance, watch for consistent language about cuts across 2 or 3 consecutive Fed statements, not just one comment before assuming rates are headed down for good. If you have savings sitting in cash, consider locking in current yields with a CD before cuts arrive. And if you're carrying credit card debt, know that a rate cut is not a rescue plan. The interest is still expensive. Cut or no cut. The bigger lesson here, you don't need to predict the Fed perfectly. You just need to understand what their language actually signals and move a little earlier than everyone else who's waiting for the headline. Subscribe to Financial Patterns every time the Fed speaks. We'll break down exactly what it means for your money.